So the moving averages we're going to take a closer look at here, as well as the Bollinger Bands, very key overlays to have on your chart. So for moving averages, they're written as MA10, and what this indicates is a simple moving average. There's an exponential moving average as well. We're not going to cover that. We're going to keep it simple with just the simple moving averages. The difference between the two is that exponential moving averages react more quickly to changes in price. So if I'm writing it here as MA10 and I'm looking at the daily chart, I know I'm talking about the 10-day moving average. If I'm looking at the hourly chart, I know I'm talking about the 10-hour moving average. So the moving average is calculated by the closing price of the previous 10 candlesticks in this instance. So the 10-day moving average is the average closing price of the previous 10 days, 10-week moving average, previous closing price of the last 10 weeks. You get the idea. Whatever number is in here indicates time period. You want to stay consistent with the colors on your charts. And what I mean by that is if I have the 200-day moving average as red, I want to make sure that my 200-week moving average is red as well. That way when I pull up a chart, no matter what the time frame is, I'm comfortable with what the colors are, and I know pretty instantly what I'm looking at without having to look at that key in the top left corner. And really what it does is saves time and makes you more comfortable with those charts. Another point to note here is that the longer term the moving average, the stronger it is. So the 10-day moving average resistance is not nearly as strong as the 200-day moving average resistance, and that's because there's a lot more data and time factored in here, and traders are well aware of that, and so they will pay more attention to the 200-day moving average as a support or a resistance than they will the 10-day, which moves a lot more rapidly. So when the price is above a moving average, let's say here's our moving average, when the price is trading above it, this acts as support and bounces off of it, and when the price is below it, it acts as resistance and rejects the price. And what the most important factor about these moving averages is that it is the close of the candlestick that matters. So I can have a daily chart, and the day can have a very strong move, and we can be trading well above a moving average resistance, but that does not mean that moving average has now become support until the price closes the day above that moving average. And if it were the hourly chart, the hourly candlestick would have to close above the moving average to turn that resistance into support. And we'll look at some specific examples of that. And we're also going to look at a back test, and what that is when the price breaks a resistance and then turns it into support. It then back tests it and bounces off that support to affirm the strength for the bulls. So let's get into some examples here of moving averages on the charts.